Last week, weak dollar Wednesday, rate cut bets and Chinese stimulus, right? What does that mean? What does it matter? If we look at the futures and we go to the chart, what happened last week, and I want to go to the hourly. So, what was the date last week? Let me see. It was the 29th. Okay, so this is the thing. This is why I'm always harping on about this stuff. All right, so it was the 29th. You see how low the dollar was on the 29th? And so my article for the day was, I talked about the weak dollar. It was called Weak Dollar Wednesday or whatever it was called. It doesn't matter. Weak Dollar Wednesday. There you go. Okay, so you see how why do I do that? Because this was, when I wake up in the morning, I generally wake up around maybe 5 o'clock in the morning, and I'll start reading. And then I decide at some point in the next couple of hours what I want to write about, you know, based on like what's the most important thing to talk about today. That's how it works. I read, and in my brain, I somehow decide, I'm like, okay, you know what's the most important thing going on today? This. And then I can start writing about whatever it is I decide to write about. Now, in this case, it was, and as you know, I kind of stream of consciousness write. I just write whatever I'm thinking of at the moment to get, but that's, you kind of have to, because the overview of the market is a lot of different things. It's not one thing, it's whatever, it's a bunch of things. Today, it was entirely about oil. But the reason I wrote Weak Dollar Wednesday is because the most important thing going on Wednesday last week was the dollar was very, very weak. And if the dollar is very, very weak, it gives you a false impression of how strong the market is, because the market is priced in dollars. Cannot be clear enough about that. The market is priced in dollars, and therefore, when the dollar gets weaker, the market gets stronger. So in other words, you know this when you go to Europe, right? The dollar is weaker and things get more expensive, right? You know the price you pay in dollars becomes more expensive. Stocks are priced in dollars, but they float like a commodity. So in other words, if IBM is $100 when the dollar is at 104, right? And then the dollar drops to 102.50, the dollar is down 1.5%. And what happens to IBM? Then IBM, now you have to pay $1, 101.5 for IBM. IBM goes up 1.5%. But it's not just 1.5% because IBM is an international company. So the weaker dollar, depending on the company, but the weaker dollar for most S&P companies, they get a lot of revenues in foreign currency. Therefore, their revenues in foreign currencies goes up. Their dollar revenues are stable, right? So in other words, IBM's earnings are stable. They don't change. The dollar amount that they're collecting doesn't change in the US. So the earnings per share are the same, except now the European earnings per share are also priced in dollars, and so that goes up. The amount of dollars the collections in Europe that they get, or Asia or whatever, in the rest of the world. So the collections they get in the rest of the world, if it's an international company, will be boosted by the weak dollar because they're priced in dollars. They're converted to dollars as they come in. And that's why you have this compounding effect, because in other words, you've got a weaker dollar that reprices a stock higher automatically. Also, you aren't losing any dollars in America that you're collecting. You're still collecting the same dollars, weak or not, but the money you're collecting from overseas is now boosted by the weakness of the dollar as well. The euros you're collecting, the yen you're collecting, the pounds you're collecting, whatever it is you're collecting becomes a better conversion for the dollar. So that's why you have this boosting effect from the dollar that's pretty much 2 times whatever the dollar drops or gains. It's 2 times in either direction, but short, and it's a short-term effect. It's a very quick repricing that sort of, it fades back in over time. But it's very, very important to understand this about the market, because when you're sitting there and looking at the S&P 500 on November 29th, that's what you see. And that is a false image, okay? It had nothing at all to do with the S&P getting stronger. It was a rally based on the dollar getting weaker. Then, like I said, it fades over time. The effect fades out over time very quickly. But then people say, oh, we were rallying and now we're consolidating going back. The TA people look at it like this. They don't think about what's actually driving this change. So they'll rally it back up, but they get rejected at the same spot again. And what that does is strengthen the resistance when you keep hitting it and failing. And then we had a different conversation this week about hitting the points of resistance, right? And today, what happened today? Well, for one thing, the dollar got a bit stronger. Back to currencies, right? So the dollar is continuing to get stronger, putting pressure on the market. Oil collapsed. And again, oil was boosted by the weak dollar, right? If you have oil is priced internationally, it's a commodity. So if the dollar gets weaker, oil goes, you need more dollars to buy the oil. And so oil popped, and that brings up the energy complex, right? And gold and silver and everything else went up. And because again, commodities priced in dollars. So these sectors of the commodity sector and the energy sector went up. And because the energy sector is doing well, and because oil is doing well, people think the economy is doing well, and they start making bets on all sorts of things. And none of it's true. It's all a trick of the light from the dollar. So when the dollar normalizes, the oil goes back down. Also, they had the OPEC meeting was coming. That was another thing we'd been tracking. And in the OPEC meeting, that happened on the weekend, basically. It started on Friday and went into the weekend. They just did not do enough to support the prices. And so they didn't make a strong enough move to support the prices. And that's what we talked about today. But I still want to finish up on the dollar. So the dollar, and then the dollar is strengthening and oil is weakening. So oil looks weaker than it actually is, which is why this morning I said when it crosses back over 70, we'd like to play it bullish for the bounce, because it's fallen from 79 to 70. And it was really, forget 79. Let's say it never should have been there. It should have been 77.50. So what's 10% of 77.50? At 70. So 70 is a 10% pullback. We haven't had a bounce yet. What kind of bounce are we supposed to get? Well, if we fall from 77.50, and this is a 5% rule, 77.50, right? Minus divided by, or not, times 0.9, that gives you 10%. 69.75 is the actual bottom that we should be at. All right, so that's a 10% drop from 77.50. And 77.50 is a fair support line. The oil tends to move in the 50s range more so than the dollar range, oddly enough, unless you get to an even dollar range like 75 or see 75 is a big support line here, or 80 becomes a big resistance line. But 77.50 is halfway between 75 and 85, obviously. So I'm 75 and 80, and it's a very significant line. So 69.75 is the actual bottom, but like I said, what you do is you don't play it on the way down. You wait until it crosses back over, and then we can start playing oil at the 70 line to be bullish. And how much is the bounce? Well, we have a drop of $7, a little more than $7. But I'm sorry, it's $7.50. It's a $7.50 drop, a little bit more. All right, and then the bounces are going to be 20%. Your bounce lines are going to be 20%, which is 1/5, because that's a 5% rule, still kicks in, right? It's 1/5 of the drop is what you expect for a bounce. So you're going to have 5 bounce lines of 20% each, and 20% is $1.50, obviously, of $7.50. So that means we expect a weak bounce back to 71.50. 71.50 is going to make you $1,500 per contract if you catch it, and that's just a weak bounce. If there's a strong bounce to 73, it'll make $3,000 per contract. We expect at least a weak bounce back to 71.50, but we wait until it crosses 70, and then we'll play it over the 70 line. If it goes back under, we get out and take a quick loss, very small, and then we just play it again if it goes back over. It's possible that we're in a massive weakness here, but I don't think so. I think that like I said, the dollar drive, the OPEC failure, so on and so forth, that's what causes it. Now, so here we are a week later, And my Wednesday article a week later is about oil. And I actually wrote this early today because I happened to get up super early, and I immediately knew what I wanted to write, which is unusual. I don't usually immediately know exactly what I'm going to write. Hang on a second. Yep. But this morning I knew exactly what I wanted to write. I don't think it tells you what time I wrote. I know I published it super early. So basically, it doesn't tell you what time I publish an article. That's weird. Anyway, so basically, I woke up in the morning. I started having a conversation with Warren about doing some research. I wanted some facts and figures for my oil article, and so I started doing the research. And I said, "Hey, why don't you write it?" I said, "Why should I write it? You've got all the stuff." I said, "Go ahead and write the article." And so this is Warren's article on oil. I was lazy, even though I was up early and motivated. I was still like, "Oh, let's see if you can do this. Why should I write it?" And so this is Warren's take on it, and he's wearing his Robo John Oliver outfit. It's a little humorous compared to just his dry stuff. I told him, I said, do a tiny Robo John Oliver, not too much, please. It's like, because he tends to overdo it. He tends to go crazy. Claude actually is now doing a better Robo John Oliver than Warren does. And Claude is Claude AI. Warren is ChatGPT. So anyway. So the point about the oil, which he made, is that what's going on here is that OPEC and Russia are selling something people don't actually want anymore. And and you can sit there and say, "Oh, that's crazy," and look at all the cars and this and that. But we've had this conversation before. I don't want to make a big thing out of it. Read the article. But the concept is, look, every time somebody buys an electric car, their fuel consumption goes from 1,500 gallons a year. That's what you buy on the average, is 1,500 once a week. Hang on, let me make sure I got that right. No, it's 500. It's $1,500 a year. It's 500 gallons. So once a week, if you drive 15,000 miles, right, which is a typical car driver drives 15,000 miles. And if you get 30 miles a gallon, this is even assuming you get 30 miles a gallon, then you need 500 gallons of gas. Wait, yes, correct. So you need 500 gallons of gas to go 15,000 miles at 30 miles a gallon. So that's even assuming that you get that kind of mileage. If you get a normal, let's say you get 20 miles a gallon, it's 750 gallons, right? So 15,000 miles divided by 20, you need 750 gallons. So somewhere between 500 and 750 gallons, right? So there's two things. First of all, even if all you do is trade your car that gets 20 miles a gallon for a car that gets 30 miles a gallon, right? You've saved 250 gallons a year. And how many cars are sold in the US every year? 16 million. So 250 times 16 million is 4 billion. 4 billion less gallons of oil per year, just from people who go from 20-mile-an-hour cars to 30-mile-an-hour cars, just from that. Now, if all those people went from 20-mile-an-hour cars to electric cars, they would save 2 more times that. They would save 12 billion gallons a year. That is just the United States of America. Okay, so times 3 is 12 billion, but everybody's not buying an electric car yet, but I'm just showing you how devastating this is going to be as electric cars pick up in adaptability. 12 billion divided by 42, because it's 42 gallons in a barrel, is 285 million barrels. 285 million barrels per year, just based on 1 year of cars flipping over. So almost 1 million barrels a day less oil is consumed if people flip from gas cars to electric cars. That's not counting the truckers saving money. That's not counting other energy efficiency initiatives around the country. That's not counting recycling efforts to take the oil out of plastics and so on and so forth. And that's just America. In the rest of the world, they're actually way ahead of us on EV conversions and so on and so forth. So this is, we're not there yet because not everybody is buying an electric car, but 15–20% of the people are starting to buy electric cars now, or at least they're buying hybrids, and hybrids use half the gas. So we're marching in this direction every year, and it doesn't come back. It gets worse and worse and worse for oil every single year. So if we use 20% of the world's energy, and we use 1 million barrels per day less gas, that would be 5 million barrels less gas every year, less oil being used every year. It's physically not used. And there's 100 million barrels of total global production every year. So you're talking about 5% less oil needed by the world, and we're not there yet. We're maybe 2 million barrels less a year right now is happening. But even 2 million is devastating for them. You can't be in a market that's shrinking 2% a year and expect to get a premium price. That's what's going wrong. These guys think they can fix it by restraining supply, but that's an idiotic way to do it, because by restraining supply, by cutting back their production, they're making it more viable because OPEC only controls 1/3 of the oil. So if OPEC is cutting back their supply, they're encouraging the other 2/3 of the world's oil producers to increase their supply. They are making oil more viable. That's in harder to reach places in the US, harder to reach places in China, wherever in the world somebody else is producing oil. They're making it more viable to produce that oil by keeping the price up artificially. And they've been doing this for years. The Saudis have been cutting back oil production for years, and now OPEC on the whole, and they've got Russia doing it too. It's the wrong solution. Their solution encourages a growth in US production, which is now at record levels. We're now producing 13 million. We produce more oil now than Saudi Arabia does. That's crazy. They used to produce 15 million barrels, and we produce maybe 8. Now we produce 13 million barrels, and they produce, I don't know, maybe 12 or 11. So all they're doing is giving away their market share. Now, the thing is, and this is how they've always played the game before, the thing is, America only has maybe 20 years worth of oil at the rate we're pumping it out. And so what we're doing would have been strategically a poor choice, because we're basically using up all our oil, leaving us at their mercy. But now, in the 20-year horizon, there won't be a need for their oil at all. We're moving off oil completely. So it is like a breakup. Like, we're getting away from this abusive relationship that we have with these guys, and we're able to use our own resources for now and not use theirs. And we aren't going to have to come, and so that, their attitude has always been, you're going to come running back to us, you can't stay away for long. And that's no longer true. We only have to stay away long enough to build up our alternatives. And once we build up our alternatives, we never need them again. So they're playing the wrong game. They're playing the game they've always played, and the game has changed drastically. And you cannot win playing the game the way they're playing it. They cannot win. They have more oil, and this is the other problem. They have more oil than they can ever use. And we talked about this, I forget, some other time this week we talked about this, or last week. There's a concept called stranded oil. And what stranded oil means is that eventually there will be very little oil, there'll be oil used for industrial things and so on and so forth, but it'll be insignificant. And so there'll be much less oil being used, and it will become worth much less. So they'll be lucky to get like $20, $30, $40 a barrel, 30, you know, maybe $30 a barrel, $40 a barrel. So $1 a gallon basically for oil will be the price. So eventually, and I mean 20 years eventually, but in 20 years from now, there'll be very little need for oil. That means that all the oil that they have in the ground now, and Saudi Aramco has a claim of 245 billion or two, no, it's like 2.5 trillion. It's, yeah, I'm sorry, it's 245 billion barrels. So 245 times let's say 50 even is $12 trillion. So they think they've got $12 trillion worth of oil, but they don't, and they're valued that way too. So they don't, and when you say Saudi Aramco, that's the Saudi Arabian government. That's the entirety of their assets, is basically this oil company. So the reality is that they're only going to be able to sell some of that oil over the next 20 years, and then people are going to be like, oh, you have you know, they'll still have, you know, they'll still have 150 billion barrels in the ground, or maybe more, and people are going to say, well, that's nice. What are you going to do? It's like people who have you know, it's like people who have a salt mine or a granite mine or something like that. What is it granite? What are those things that they have that are usually swimming holes? I think it's granite, right? I mean, it's like they basically they chop up the mountain, and you end up with like a water, you know, the water seeps in, and you end up with like a nice place where all the kids go to swim, but it's not worth anything. It's just a bunch of rocks because we don't use it the way you used to. You know what I mean? These artificial swimming holes, they don't seem artificial, but they're rocks that were mined long ago. So, you know, people are going to be like, well, okay, oh, that's nice. You got a bunch of oil in the ground. So what? You know, not only that though, but synthetic versions of oil are going to come out in the next 20 or 30 years also, and so we may not need any of it. So what does that mean though? So that means that this company that's being valued at $1 trillion or $2 trillion or whatever Saudi Aramco is being valued at, they're being valued based on assets that are actually not worth anything like what people think they're worth. And that's true for Exxon and others. But we looked at the American oil companies, and nobody touches Aramco, not by a mile. So you look at the holdings of other companies. Exxon has like maybe 15 years worth of oil. So you know, based on what they sell and based on what they have in the ground, they've got like 15 years worth of oil. But they also place a very low value on it. They only value their oil at about $10 a barrel. So they're not really in trouble. They will make money, not as much money, but they'll still make money selling oil at whatever price for the next 15 years. And all they have to do is not buy any more of it, and figure out something else to do with themselves. So it's very complicated. It's very long term, but it's very real. And the gist of it is, though, oil's not worth what you think it is. It's only being propped up because the people who have the oil are refusing to sell it. They're not selling that much of it, but they can't keep it up because they need it for that's their entire economy. Russia's economy is selling oil. Saudi Arabia's economy is selling oil. How much can they keep cutting it, especially when it's having no effect? So now they're not producing as much oil, and they're getting less money for the oil. Therefore, it's drastically reducing their economy. And when I say their economy, you know, Saudi Arabia's got a royal family with like 20,000 princes, and they all get their allowances, which is like millions of dollars. So they all get their share of Aramco profits. It's like a great big family, but imagine if you came from a family like let's say you're Bill Gates the 14th or something like that. You would be damn sure you knew what your lineage was and how much of the inheritance you get, right? It's not like a regular family where you don't really care who your relatives were 5 generations back. These people, believe me, if you're in line for the payout, you've got very, very clear determination of who's a cousin and who gets this share and who gets this from what. That's what happens though. Every year it breaks up over more and more and more people. It's divided among more and more of the heirs and diluted out. And so each generation can't live the way they can't live the way that their predecessors did, that their parents did, because they are now dividing the money by a lot more people, and they have a lot, and they tend to have a lot of kids too, so they spread like wildfire. So it's messed up, and so and most of the money goes to the princes, and some of the money goes to the people, but that's their entire economy. So you're talking, you know, infighting, possible revolutions in these countries. You're talking about massive imbalances. You're talking about another collapse of the Soviet Union ahead of us. You know, this is why Putin's in this distracting war. You know, he wants his people to focus on something besides the fact that Russia's, you know, basically running themselves into the ground financially. So this is the most important thing of today to talk about. And little did I know that oil would start collapsing the way it did today, but possibly because of something I said. I don't know. But like I said, when it gets back to when it goes back over 70, in fact, let's just pick up a share now. Why not? So we go trade. So we'll take a look at it next week. I'm pretty positive next week we'll be in better shape. Active trader. Oh, there's oil. And buy one. There you go. That was easy. See, well, see, you got oil. Here it is. These are the futures. Everybody thinks the futures are a big deal. It's not. And I just bought a contract at 69.68. If it goes down significantly lower, I'm happy to buy another one and hold on, because I really do think we should bounce back over 70. Somebody will say something to get oil back up at some point. And we're coming into the Christmas holidays, and there should be a lot of travel and so on and so forth. So we'll see. But anyway, so just to keep a marker on it, we'll buy the oil here and see what happens. And it moves every point, every 1/10 of a cent, oil goes up. I'm sorry, every 100th of a cent, every penny. I'm sorry, not 1/10 of a cent. Every penny oil goes up is $10, or up or down, it's $10. So see, now we're up 30 bucks already. That was a fast 30 bucks, right? Good hourly rate, 60 bucks. My hourly income is increasing. So like I said, just a pointer, really, if you want to play it correctly, but I'm, you know, because I'm doing this, I'm not going to be able to pay attention. If you want to play it correctly, you don't play it until it crosses over 70, then you use 70 for the stop line. That prevents you from losing a lot of money. I don't care if it goes back to 69 again, I'll buy another one and I'll average 69.30. So I don't really care. I'm playing with deeper pockets probably than you should be. So that's where we are there. Now, let's see if we have any questions. No questions, because I'm so good at this. All right. Now we'll move on, or move back. We're not moving on, we're moving backwards. So last week we talked about the dollar. This week we talked about oil. But then after last week's webinar on Thursday, it doesn't go back to Thursday. This is what happens when I write extra posts. Oh, I'm going to make a complaint. I'm going to complain to you guys. Nobody ever makes a comment on the weekend wrap up, and I find that very annoying. It's like I want people to talk to Claude or Warren, whoever writes the wrap up that week. I want people to talk to the AI. They wrote the article. Ask them questions or ask them whatever you want. But it's like I want to test their ability to actually run a chat room and answer questions and so on and so forth. And nobody ever participates. So please do. All right. So that was Wednesday. And then on Thursday, we announced officially our trade of the year. And we'll go to that article now. We'll talk about that because that's kind of important. So the trade of the year, well, PhilStockWorld, not like that. PHIL, that's me. Watch list. Isn't it great that we're this famous? All right. So last December, I put up a watch list. And frankly, I didn't even, well, I'm sure I'll say so here. Back on Thanksgiving. Okay, yeah. So what happened is last year, we did our trade of the year. We picked Yeti. Well, how's Yeti doing? Okay, I got to stop being distracted. All right. So now I have to know. Damn it. Okay. Yeti. Futures. Where the hell are my charts? Chart. All right, great. So that was actually our target for Yeti was 45. So we're in good shape. All right. So last year we picked Yeti for our trade of the year because I thought this was stupidly low. and it's already at the top of our range, so we're good there. So I feel better. All right, now let me find my. All right. So in doing that, though, we looked at all the stocks, and of course, it's when you say when you say you look at 6,000 stocks, I look at 6,000 stocks, but we eliminate 5,000 of them in 10 seconds. It's like they're not the right price, they're not the right this, they're not big enough, blah blah blah. Then we go through the 1,000 and we knock them down pretty quickly to a couple of hundred. But once we get to a couple of hundred, we start seriously looking at every single one, looking for the gem of the group. And when I say the gem, it's a combination of things. But the most important thing is this stock is so low, I'm almost 100% positive it can't go any lower. That there'd be no reason for this stock to go lower than it is right now. That's the most important thing. I found a floor. Because when you have a good floor using options, you can construct trades you will never lose money. So we look for stocks with a very, very solid floor that have, it's like you can't even imagine how they could go lower. I can't even think of a scenario, and that's what happened here in their final eliminations. We can't even think of a reason why it would go down. A realistic reason, of course. So this was, again, keep in mind, this is last year. So we were talking about the stocks from last year, and we had, and we were still narrowing it down, but these were our top stocks, and there's about 100 stocks on this list, but this became our watch list. The top 100 became the watch list. And if you look at what they are and you look at the performance from last year, keep in mind, so we're picking these in December of last year. And so ACAM, very good. Allstate, not so good, but now it's better than it was. ADP actually has fallen off. Apollo, much better. Broadcom, massive gain, 50% up. Boeing even is, because December's over here. So Boeing's well up from December. Barclays had a rough year, not really good, but they're one that we still like very much. Big Lots did not do well. Booking.com, phenomenal. I mean, almost a double. Blackstone did well. Where's December? Well, they're above December now. Let's put it that way. This is a little sporting goods company, BGFG. Not good basically, but again, I think this is a heck of a bargain here. BioNTech's biotech hasn't moved. It's gone down a bit. Berkshire Hathaway, of course, always a winner. Blackstone Mortgage Trust, people were hating them for a while. We got very interested. And by the way, this is a watch list. We didn't buy these in December. They're stocks we wanted to watch in December so that if this happened, we knew to jump on. We were like, well, we like stock here, so anything that gets cheaper, it's 100 stocks. So the purpose of the watch list is to say if it gets cheaper, we want to buy it. So it's not really whether it went up from December. It's where it's more like if it went down from December and then it went up, we jumped all over it. Boyd Gaming, we liked a lot. They're up. Citigroup, of course, everybody had the March crash, right? We did buy Citigroup on the crash. Cheesecake Factory was down here, then it was here. It was up, down, down, and now it's going up again. This is a silly one not to own Cheesecake Factory. Caterpillar, very nice, right? Capital One, doing much better, even though they have that crash. CIM is one of our favorite REITs, and they're doing what they always. Now, a REIT, I shouldn't go through this as 100 of them, but a REIT is not going to do well quotes. You can't see me quote. I'm like quoting at the microphone, like that helps. So CIM is not going to do well because they give away all their money. A REIT distributes 90% of their profits. So if you're going to distribute 90% of your profits, then how are you going to do better? It's very tricky with a REIT, right? They basically buy these buildings, they make money from the buildings, but they don't reinvest the money they make. They redistribute it back to the shareholders. Well, they can reinvest, but that's a big decision because then it takes away from the distributions and people get mad. So once you set up a REIT, you're basically locked into this sort of cycle where you're keeping yourself at a certain level. Anyway, you get an idea of like a whole variety of things, and most of them did pretty good. Coinbase was one I'm really proud of because we huge holding long-term portfolio. Although I did just call for our covers on this because it's overboard. Crocs is one I love. Cisco, Chevron I would no longer buy. That would be off our list now. Most of these stocks are still valid for our watch list, but most of them have already taken off. So there's very few that we can actually go for that say Disney's still pretty cheap. There's not too many stocks left that haven't taken off from our watch list, frankly. eBay is still a decent buy. They got a lot of stuff going on. Energy Transfer, we just talked about them today, how they control the Texas natural gas pipeline market with an iron grip. Anyway, that was last year. So from the watch list, we had revised it. We looked at it a couple of times this year. We narrowed it down. We dropped stocks off the watch list because things change. But for the most part, the same premise we had last year holds up this year. And that premise is I want stocks that have low debt, low PE, so low price to earnings ratio. You're not paying a high multiple for the stock. I don't want debt because rates were rising. It's not as much of a big deal now as it was then, but you know, in a rising rate environment, why would you own a stock that has a lot of debt? You're going to end up paying more money in interest. And then the other metric we looked at, which is why we did so well, because it's a very good metric to watch, was a high profit per employee ratio. And those are all over the place for companies. I mean, you know, a company like Walmart, they only make about $10,000 per employee, but Apple makes $1 million per employee. You know, so which one should you buy if labor costs are going up? Well, Apple could care less if the employees make $10,000 more. But in Walmart, if they have to pay their employees $10,000 more, they have no profit. Obviously, they got to raise prices, but you know, it's conceptually. So that was a big metric that saved us last year and gave us a really great selections. We're not using really different metrics this year. The situation hasn't changed that much. And what we did is we took those 100 stocks that were on the watch list and we narrowed them down to 7. At this point, there were 20 last week when we were talking. There were 20. Now there's 7. Or I'm sorry, there were 7. Then there were 7. And so these were the last 7. So this article, though, from last week, the 2024 trade of the year, highly recommend if you want to. We talk about a lot of stuff here. So we got it down to Crocs because they're inexpensive casual shoes, and people work at home more than in the office now, and so casual shoes are doing better, and that's actually hurting the nice shoe stores are not doing so good, right? Because people aren't showing up at the office. Not, you know, about probably 30% of the people who used to go to offices still aren't going. In Best Buy, people are buying, and again, it's also the same work from home, right? If they're working from home, people are buying more and better home computers, and they're buying them at Best Buy instead of your company. If it's a big company, doesn't probably buy from Best Buy, but you personally, if your company gives you $3,000 and says go buy a home computer for your work from home setup, you're going to go to Best Buy. So Levi, obviously, again, something everybody uses all the time, whether there's a recession or not. I love Levi, and again, and also because they're in a cycle, in part of the cycle where they're cheap. MP Materials is the only company in America that that produces magnet materials, what they call rare earth materials that make magnets. Magnets are everything in electric vehicles and other electrically run products. So, you know, this is a non-China source, so it's strategically valuable to the U.S. Vale is a South American company, and they are an iron ore miner. And again, it's not China. You know, so you know, when you have things that are not China, they're valuable. Paramount, ridiculously undervalued studio. I mean, you know, think of Paramount is like Star Trek and Paramount Studios and their MTV, their CBS. You know, the value that they're at now is just ridiculously low. And I predicted, and I was wrong. I thought this summer they would get bought, and we thought the most likely person to buy them would be Disney, but Disney had their own troubles this year. So they didn't get bought, basically. So we'll see what happens. Somebody will buy them, though. Corning makes all the, you know, whether you buy an iPhone or a Samsung, or you buy a laptop, or you buy an iPad, whatever, basically whatever you're buying, if it has a glass screen, Corning makes it. That's most likely Corning makes it. So, you know, that's not going away, right? And that's what I like. I like things that are not going to go away. Okay, you can have a recession. You know, I mean, think about this with your kids, right? What is the last thing you're going to be able to do to your kids? You know, assuming you have control of them. But I mean, the last thing is like take away their phone. Are you kidding me? Like, tell them they can't have another phone. Tell them if their phone breaks. That's the other thing. You don't have to buy a new phone, because if you hold a phone long enough, if you have a phone long enough, it will eventually break. It's very unlikely people have phones for 5 years and never crack their screen. So one way or another, Corning wins. Whether you don't have to get a new phone, you still need a new screen. So I like that about them. So for Paramount, I said I'm fairly certain they'll be back to 18. Then look how they popped already. And so we talked about that. Here's the trade on Paramount. And again, there's $120-something thousand worth of upside potential on these trades. So this one has $10,000 potential upside, but you're paying net 100. Now, the net 100 is how much cash. So 19.5, and you're selling the calls for 14, and then you're selling these puts for 5,400. So that leaves you with net 100 cash. But what your real obligation here is, you're saying, I'm going to buy 2,000. We're selling 20 puts. So you say, I'm willing to buy 2,000 shares of Paramount for $12.50. All right. I can't talk to you, dude. Okay. See, I forgot about that from last week. I got to turn off this app that makes it ring from my phone. So where was it? Yes. So you sell 20 Paramount puts at $12.50. You're saying, I will buy 2,000 shares of Paramount for $12.50. They're not going to make you buy it unless it goes below $12.50, because it wouldn't make sense for them. And your cushion is really, well, you know, ignoring the spread, your cushion is really actually $2.70. So you're really below 10. So net below 10 is where we're agreeing to buy Paramount. I think 10 is a very solid floor. I think Paramount should be more like 20. So you know, this would have been the trade of the year, except the risk. They've just been such a complete disaster and so unloved, and perhaps nobody ends up buying them, and they just sit there. And if they fail to execute, they could go back down. I don't think so, but I mean, it's possible. And if it's possible, that's how tight this is for the trade of the year. It's just a possibility that could happen, takes them out of the running, which is a shame. But as a spread, now, and again, keep in mind, these are the 7 best trade ideas out of every stock, out of 6,000 stocks. These are the 7 best trade ideas. So they, you know, none of them are bad. So just because they didn't make trade of the year doesn't mean they're a bad stock. So in this situation, we've got the 750, 1250. It's a very conservative spread, notice. We have the 750, 1250 spread. The stock is at $15. It only has to stay over 1250, and this spread will make you $9,900 back on $100 you lay out. But it's not just $100, because you're obligated to buy $25,000, 2,000 at 1250. So 2,000 times 12.5. You're obligated to buy $25,000 worth of Paramount stock. That's your, oh, and let's say you lose $100 too, so it'd be 25,000, so plus 100, and we divide that back by 2,000 shares. Oops. So you're paying $12.55. So your net cost is $12.55. It's at 15. So that's like, it's at $15.50. It's like $3 off the current price. It's about almost 20% off. Is your worst possible case scenario is you own Paramount for 20% off, and we think that's a ridiculously low price. And that one didn't win. and that came in last out of 7. So that's a phenomenal trade. Then we've got MP, and again, MP. Now, why did MP not win? Here it's interesting. Now they have rare earths. They're in they've got a rare earth market. They've got 1,000,000% demand. They can't possibly supply as much as the demand is. They have a huge shipping advantage to China, obviously. So in other words, they may be more expensive in America to make the rare earth materials, but they don't have to ship them from China, and you don't have to wait a month or 2 months to get what you order. So that's huge. The trade idea here, we spent more money. We spent $11,300, but that's because we are rock solid certain that this is a stupidly low price. So in this case, we sold the $15 puts. We put our foot down at 15. And we sold those puts. We bought 50 and 40. Notice we bought 50 and 40 because eventually we're going to sell some short calls too and make an income out of this. So we're going to reduce this basis over time. And we risk owning 2,000 shares for $30,000, but it'd be actually $40,000 because we're paying $11,350. But just to be clear, in other words, oh, I'll show you. So what is it, MP? So we didn't fully cover. That's why it's expensive, is because we did not fully cover the spread, MP. So we have 10 open long calls, and we can take those 10 open long calls and we can sell. They're at $16.50. Let's say we sell 10 of the March 1750 calls, right? So it's at $16.50. You'd have to go up $1 for those to go in the money. If we sell 10 of those, we're going to get paid $1,600. We cannot lose because we already own 10 extra long calls in 2026. We have 700 days to sell, and we used 100 days, so we can do at least 7 more. We can do 7 more sales like that. I forgot now. We bought the 1250 calls. So we will absolutely be able to roll those. In fact, we sold this for, what we say, 160. So it's 160 for the Marches. Which calls are 160? The 35. So we could roll them to the 35s. We have no issue at all. So in other words, we can't possibly lose money. And we're going to have 7 times that we can collect $1.60, or 8 total times. So 8 times 1,600. Well, that was divided. 8 times 1,600, $12,800. So in other words, the plan on this trade, so we sell 20 puts, we have 50 long calls, we have 40 short calls. If we sell 10 quarterly calls 8 times, we're going to collect more money than the net of the spread. So this spread starts out at net 11,350, but it's going to turn out to be net 0. That's the key to that strategy. So we take a hit at the beginning and lay out a decent amount of money, but we're going to reduce our net to 0. So this will pay a lot more than $26,150. And don't forget, you're only paying net 11,350, and as soon as we sell the first set of calls, and we're not selling it right away because we're waiting for it to pop. Why should I sell it now? It's too cheap. But we can at any time when we decide to sell it. So what I'm basically saying to you is I'm saying, hey, for 11,350 out of pocket. Oh, I shouldn't have done that. So you can sell calls for $1,600 every quarter, divided by 11,350. 14% is your quarterly income while you wait. So 60% a year is your income while you wait to see if your spread works out to be a $37,500 spread. So the money you put to work, the cash you put to work of 11,350, you're going to get a 60% annual return on this cash while you wait to see if you end up at 20. And if you end up at 20, you'll have a bonus of $37,500. Didn't make the trade of the year. 5 trades are better than this one. Five plays are better than this. Here's Best Buy. Oh, I'm sorry. Why didn't it make the trade of the year? You know why it didn't make the trade of the year? Because I realized when I was looking at them, MP, I think I said that here, MP stands for Mountain Pass Materials. That's the name of their only mine, and that mine is in California. California is the state that passes crazy propositions all the time. So it is possible that a bunch of environmentalists can decide that they're doing something horrible. MPs, and by the way, MP, very environmentally conscious. That's why they're operating in California. They do everything right. They comply. They haven't had problems. Nobody wants to shut them down. But if some crazy people start protesting that some snail is being threatened by them or whatever in California, they could have their whole operation suspended. It's a long shot, but it's the same long shot as when you bet on, oh, another reason Paramount, we just had a writer's strike, right? You know, it's the same long shot as saying, oh, well, the writers could go on strike or the auto workers just went on strike, right? So, you know, you have to take these things into account that something could happen and that would derail my trade of the year. If it wasn't a trade of the year, I wouldn't care. If it was a trade that I took and I'm long term and I could care less what happens in the next 6 months, great. That doesn't work for my trade of the year. My trade of the year has to have nothing go wrong in the next 12 months. So it's possible that something could happen and they shut this company down for some period of time. They don't have a diversified base of revenue. They only get their money from one mine in California. What if there's an accident? What if there's an environmental change? What if China suddenly starts sending don't even ask me to pronounce it, neodymium and praseodymium. But what if China starts sending that stuff to America really cheaply or something like that? It's, you know, again, not likely, and certainly wouldn't stop me from making this trade in a portfolio, especially when I can make $26,000 plus the income. It certainly wouldn't derail me from playing it, but it's not necessarily bulletproof. And that's what the trade of the year has to be, is as bulletproof as possible. All right, so Best Buy. The reason Best Buy lost out is because of the stretched consumer. We already have Best Buy in the short-term portfolio. That's why it's not blue or any color. Like this one was blue because we're adding it to a portfolio. We put it in our long-term portfolio. This one's not because we already have Paramount. So blue means putting it in a portfolio for our members. This one, we already have it in the short-term portfolio. And in the case of Best Buy, it's straight up. We're not playing any games. We're just basically, we're Best Buy, and Best Buy is popping right now. With Best Buy, we sold the $60 puts. 60 is below the low. It's below this low, and it's below this low. So 60 is below the lows, which we feel are very solid support. We bought the 60 calls and we only sold the 75 calls. So this stock is already over our goal. And our goal is net $4,300 that we spent on the spread. It's a $30,000 spread. It's It started out 20,000 in the money. It was at 70 when we started. Now it's at 75 already. And that's great. I made the comment, aren't options fun? You have to understand what this is. We spent $4,300 with this spread, or with the stock already at 70. So these $60 calls were already $10 in the money, and these $60 puts are $10 out of the money. And so we bought $20,000 worth of intrinsic value for $4,300. Why would you not do that? It's funny. I talk to people who think options are so evil, and they have absolutely no idea how much better they are than trading stocks. And it's not even complicated. In other words, we bought the $60 calls saying we will buy this stock for 60. We sold the $75 calls saying we will sell this stock for 75. I don't have a problem. I don't own the stock, but I promised to buy it for 60. Or I'm sorry, I didn't promise to buy it. I have an option to buy it. I've paid $30,000, so I may buy it at 60. I turn around and sell for $16,000 the right for this man to buy it for 75. Now, if he buys it for 75, then I buy it for 60, and I make $15. Very, very simple. If he buys this for 75, if he exercises his option, I just turn around and exercise mine and buy it for 60, and I make $15, which is 15 times 2,000 contracts is $30,000. Not at all complicated. This gentleman, different trade, let's say, I promised this guy, he paid me $9,700 in exchange for my promise to buy the stock for 60 between now and 2026. Anytime between now and 2026. He paid me $9,700 for this right. Anytime he wants me to buy the stock, I will buy the stock for $60. If it's at 100 or if it's at 40 or 20, I have to buy it for $60. That's the contract I have with this guy. But that's no different though than if I bought the stock. If I bought the stock for 60 and it went down, I already did pay 60 for it. In this case, I'm not paying 60. I'm getting paid to promise to buy it, and my net is 60 minus 970 is $50.30. And that's $50.30 when the stock was trading at 70. So $20 off 70 is like 30% off. I mean, options are absolutely amazing, and it's only because people don't understand it and people can't do math that they don't play them. There's a whole thing about options that you talk to people about options, like, oh, options, that'll kill you, blah, blah, blah. No, it won't. Not if you do it right, not if you use them properly. It makes no sense to buy stocks if you understand options. All right, so that's Best Buy. So there's a potential what is it, $25,000 upside. And I'm telling you, at the end of the year, next year, we'll be able to look at this and say, oh yeah, that remember the spreads we talked about here? They made $100,000. Here's Crocs. We talked about that before. I was, as I say, banging the table on these for the members. I was so like, how could you not buy this thing? So I said, now Crocs had taken off on us. So we've been looking at Crocs, and we already have this in our portfolios, so that's not a big deal. So we because it's in our long-term portfolio, it's in our income portfolio and our long-term portfolio. It's stupidly cheap, and when I thought that this was good, they were going to be the trade of the year. They're basically at $80. I think that's insanely low. So it had taken off, and I was almost not going to include them because it was almost at 100 already. So it was up 25% from where I was going to include them as a trade of the year. But again, because of options, I can sell the 2026 $100 puts for $20. So what am I doing? I'm selling, someone's going to pay me $20. I'm selling the put contract. Somebody's going to pay me $20 for me to promise to buy the stock from him for 100. So I'm thinking Crocs will be over 100. He's thinking if it's under, I want to make sure I get 140. He's willing to pay me $20 to guarantee he locks in his $100. I'm taking the $20. That means that if I do buy it though, I'm only paying net 80. 80 is the price I wish I would have bought it for. So I'm looking at a stock a month after it takes off from the bottom and saying, I can't believe I didn't buy it at 80. And here I am setting it up so I can buy it at 80. I'm reversing time. That's how powerful options are. I can turn back time. Cher would be very happy, right? So that leaves us with 3 final stocks: Levi's, Vail, and Corning. And I said they all share a common theme. These are things people need: jeans, raw material, and phone screens, whether the economy is good or bad. So I start looking at other factors. I start getting really nitpicky, okay? So in 2020, let's say we have another COVID crisis, not off the table. In 2020, Levi's lost $127 million. Vail lost $1.3 billion. Corning made $500 million because, again, like I said, here, drop my phone. You need phone screens. You always need phone screens. You will never not need phone screens. Until they invent some other thing to make phone screens out of, you are going to need this stuff. So, and also as a catalyst, we're coming into a phone cycle, right? Everybody's buying the iPhone 15s and the other phone manufacturers are coming out with their stuff. So this is all going to be, we're going to start seeing the Christmas numbers now. Apple's back to $3 trillion today. They're back over $3 trillion. I don't know if it held up. Anyway, so, it's a juggernaut. It's basically, and every year on the planet Earth, do more people have phones or do less people have phones? Right? So that's an interesting concept. Let's find out. Bing, is this Bing? I think it's Bing. Yeah, Bing. No. What is all this crap? Chat, there you go. Oh, they keep changing it. It's so annoying. What do you mean? Oh, I thought it wasn't going to work. How many people on Earth have cell phones? That's a great question. No, that's good. I like Statistica. What? What? Okay, what was my question? How many people have cell phones? Not all these devices are smartphones. Smartphones, okay, so I mean smartphones. You're right. He's right. I asked the question incorrectly. The number of smartphones is 6.9 billion. You're kidding me. There's only 1 billion people left who don't have smartphones. That is amazing. Wow. Look, China, 1.6 billion. Every single person, even babies in China, have smartphones. India, everybody has a phone. America, everybody has a phone. Homeless people have phones. Babies have phones. This is crazy. All right, anyway, so the point I was making, which is less of a point now, is that next year, there won't be less people with cell phones, okay? There will be more people with cell phones next year. There will be more and more people with cell phones until every single human being has a phone. Apparently too. There seems to be more phones than people. Not only, and it's not just smartphones though, it's smartphones and laptops and things like that. It's any kind of mobile device that has a screen. There's a high chance, it's probably 60-70% chance it's a Corning screen. So the point being though, Nobody's going to take a smartphone and say, I don't want to, next year I'm going to get a phone without a screen. That's not going to happen. Every year more people get them. So it's a growing market, not growing as fast as I thought. I thought it was more like 20% don't have phones. I can't believe only 1 billion people don't have phones. But anyway, so there will be more and more phone sales as time goes by. And so we don't see a problem with them, and we don't see how they can, really have a bad year. I think ultimately they came in second. GLW bottomed out in 1951. And I'm talking about where they bottomed out in price. GLW bottomed out in 1951, and it was down for just a month before rocketing back. I mean, that's the kind of granularity we're at now. We got to pick between 3 phenomenal stocks, and I'm just trying to find a reason not to pick everybody. So they hit 1951, but they rocketed back to 30, and it's now 28. So in other words, it didn't even last a month. A month after a month, they're back to $30. So there's serious value there that many people see, obviously. Vail hit 750, and it was back to 12, and it's now 15. Levi was 1141, but it took 3 months to get back over 15. So GLW is lower than it was before COVID, and it recovered the fastest since COVID. So I said that's the kind of resiliency we're looking for. GLW, however, and here's what killed GLW: debt. They have 5.2 billion in debt. Now they're a big manufacturer. Manufacturers have debt. All right, so I ran the numbers on the debt, and I said it's not terrible, but if you take a worst case scenario for their debt, you could say maybe they're not really going to gain. But I said I just can't see any other. It really is just we're just trying to find something bad about them to say. That's really where we are with that. Vail has 41 billion in debt, but they're a miner, so that's a whole different thing. They're an iron ore miner refiner. It's a whole different concept of an operation, and it's 41.3 reals, not of the. Oh, that's true. A lot of companies that are priced in foreign currencies, they're very misvalued because analysts are lazy bastards and don't do conversions, and they don't understand. And it's also Yahoo's fault. Because you look at Yahoo Finance or a lot of the financings, they'll price the market cap is obviously because it's on the U.S. exchange, it's priced in dollars, but then the earnings are priced in some goofy currency, and the goofy currency doesn't match up in any way, shape, or form with the valuation. You've got to convert all the numbers before you can analyze it properly, and I will tell you that almost no analysts do this, and that's why you have a lot of these companies that are priced in strange currencies, even yen though. I mean, even Japanese companies that are priced in yen, they get ignored by the analysts, and they don't value them properly, or they take the wrong number and they misapply it, or so on and so forth, or the currency changes and people thought it was a good deal, it turns out to be a bad deal. So there's a lot of mismatches in these kind of companies, and that's why Vail is so stupidly cheap at 7.65 earnings. It's an iron ore miner. It is like a rock steady business. And in fact, we look. So then what do? We start looking. Well, what's iron ore pricing look like? Well, here's the price of iron ore globally. And since 2016, it's been basically up and up and up and up. It spiked up stupidly for whatever reason, but it doesn't matter. We don't care. That's to our benefit when it spikes up. Does it spike down? No, it doesn't really spike down. It spikes down from when it spikes up, but it keeps steadily rising. We have no reason to believe that Vail is going to go down significantly. Also, if we look at last year, 2023, right? The average of last year was about here in the middle, right? So we're starting, I'm sorry, 2022. No, that's right. Sorry. So 2023, the average is maybe 110, right? But we're starting this year. We started last year at 80. We're starting this year at 120. We're starting this year 50% higher than we started last year. So right off the bat, boom, they're making way more money selling their iron ore than they did last year. So they're going to have, and you can see it here because look at where the big dip was in 2022, the end of 2022, and at the beginning it took them a long time to get back to a good price, right? We already know that the fourth quarter of 2023, this last part of 2023, is significantly better than the fourth quarter of 2022. We know that for a fact. And the first quarter is almost certain to be better than the first quarter of 2023 was. Therefore, what do I know? I know that if I invest in Vail, I've got 2 quarters in a row of very strong positive catalysts where they significantly beat their prior earnings. So unless the price of iron ore is significantly down from where it is now, and global economically, we don't see why it would be, then Vail's going to have 2 astounding quarters, and people are going to suddenly go, oh my God, that's so cheap, this company. It's crazy. Then I said 80% of their revenues come from iron ore. So we look at the iron ore pricing. That's what I said. Okay, so blah, 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 blah. Okay. And China just announced that they're going to start supporting a lot of infrastructure plays and other plays, and that's going to benefit Vail as well. The amount of iron ore they sell for construction is nothing compared to building, you know, the ships and the autos and everything else that they do, and the infrastructure is huge for them. So, and also, if you look at, and we did, if you look at the inventories of iron ore at the ports in China, we find that the iron ore is depleted. It's lower. There's a lower level of inventory in China of iron ore than there was last year. So they need more iron ore. They've been depleting their reserves, and it's going to restock at some point. So there's many, many reasons why this should become a great play. And we couldn't really find a bad one. We couldn't find anything other than the debt, which is, you know, again, for a miner, it's completely normal. Other than that, we really couldn't find anything wrong with these guys. And very manageable, very serviceable debt in their case. So Corning already in our long-term portfolio. The spread we did for Corning, again, it was an open spread because we intend to, when they come back up in price, we intend to sell some short-term calls. So we leave the 5 open so that we can sell. Now, you can sell 5 or you can sell 10. So in other words, if Corning's up at 36 and we think they're hitting resistance, we might sell 10, we might sell 7, right? But if it's lower, if it's petering out here and we just decide we want to get some income, we'll sell 5. We can't be hurt selling 5 because we're already covered. Can't hurt us at all. So with complete immunity, we can sell 5. And it's the same thing as the other one where we talked about getting that quarterly income while you wait for the spread to come in. Meanwhile, the spread was kind of aggressive because we think Corning is ridiculously low, and we took the 25.37 spread. So we're buying in at 25. That's down here. See, that's where we're buying. We're buying at 25. We're selling at 37. That's our target. And we also sold the 32 puts, which are up here. So aggressive put selling. And we net $37.50 on the $30,000 spread. We have $26,000 of upside, and that's 700% return. Not our trade of the year. That came in third in the end, Corning. Levi. So I said, here, so it's going to come down to, as far as between Levi and Vail, it's going to come down to what's more likely in 2022. Will consumers cut back on discretionary spending, or will China? So in other words, which is more likely to happen? Which is more likely to derail our pit? Will consumers cut back on discretionary spending, or will China use less iron ore? Since China is looking to diversify their economy away from real estate, that's very unlikely. Their goal for the year is to use more iron ore. That's actually their goal. Not specifically iron ore, but things that require it is what China's basically working on next year. So since China can print their own money and consumers can't, we ended up picking Vail over Levi. And so that means adios to Levi. They're solid number 2. We didn't have them in our portfolio, so we added them to the long-term portfolio. And here we sold 20. And again, notice the same kind of pattern, right? We sell 40, we buy 40, we sell 35, so we have room to make income. And we were conservative here because we don't think Levi has a lot of growth, but we do think Levi is at a bottom here. But the spread we're buying is essentially in the money. It was 100% in the money. It still is. We're over 15. So it's 100% in the money. We're promising to buy 22,000 Levi's at $15. So it's promising to buy $30,000 worth of Levi stock. The net of the spread is $87.50. It's a $20,000 spread, but it's 100% in the money already. It is already 100,000 of the money. We're going to sell calls, short-term calls, to reduce that amount. And if Levi goes down for any reason, we'll certainly double down on the spread if we can get it cheaper. But that's by the way, another reason it lost was because we don't have the option spread we felt was appropriate for it isn't going to return the 300% we want to return. That was another reason they lost. So Vail, in the end, became our trade of the year because the infrastructure spending, it's hard to imagine, as I said, hard to imagine a drop in iron ore. Even if there's a recession, you know, what do they do for a solution to the recession? They do infrastructure spending. They also have easy comps to beat for the 2 quarters, and that's the kind of catalyst we want to see. We already have Vail in our LTP. We have an aggressive, very aggressive position on Vail in the long-term portfolio, but now we're adding it to the Butterfly portfolio. And the Butterfly portfolio is all about selling those short-term calls. That's what we do. And look how this one works out. So we're promising to buy 1,500 shares at $17, and Vail is at $15 now, or a little bit less. So we're being a little bit aggressive here, but we're going to absolutely make this money back, so we don't care at all. You know, that's about what, $25,000. So we're promising to buy $25,000 worth of Vail, but we're gonna be able to sell $25,000 worth of puts and calls. So even if the stock's assigned to us, we're going to collect all the money. It'll be free. So the net of this spread is $1,000 on a $12,000 spread. There's $11,500 of upside, which is 1,150% upside potential. Don't forget, 300% is our goal. So if we have that potential, we got a pretty good chance of making it. And that's for Vail to make it up. Vail only has to be at 15 for us to collect the 12,500. They have to be at 17. And if they're at 15, we would get 12,500 for the spread, but we would have to pay these guys back $2. So we'd have 12,500 minus 3,000, 2 times 15. So we'd have 9,500, but that would still be a 950% gain. So at 15, we make 950%. It takes a lot for us to lose. If it goes to, if it drops $2 more, then we would net $6,000, I think, roughly 65. We would net see if it dropped to 12. If it drops to 13. We'd have to give these guys back $4, so that'd be $6,000. So it'd be $6,500 net. Oh, I'm sorry, and it'd be $6,500 and $2,500 less. So we'd actually only collect $4,000, but that would still be up 300%. So this thing can drop all the way down to 13, and we'll still be up 300% on the spread. But also, you have to understand these $17 puts, we can do what's called rolling them. We can move them to a longer, you know, as Vail goes down, we can roll them out to like 2027, 2028, and we can drop the strike. So even that's not set in stone that we would lose that money. Anyhow, so blah, 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 so whatever. So this is a phenomenal trade. We also think Vail is so stupidly low and it has such easy comps that it's going to be back up around 17, 18 very quickly. And I said here, for example, we could sell 10 of the March 15 calls for $1.05, and that uses 106 of our days. So if we have 8 times 105, I mean 8 times that, we can collect $8,000 back. Now understand, we only have a net $1,000 entry. If we sell these calls if we sell 10 calls for $1,000, we're making 100% back each quarter while we wait to get our 1,000% gain. We make all of our outlay comes back the first time we make a sale. So trade of the year. that's what it takes to be a trade of the year. It's just insane upside potential. The 7 trades we just went over have a total upside potential of $120,750, and they're very diversified, very strong, can go into your portfolio. And of course, it's about the ratios. So in other words, if you don't want to spend so much money, just drop your ratios down. But if you keep the ratios correct and follow what we're doing, it's very easy to establish trades like this. So Clay says, what's my opinion about Stellantis? That's way off field. I think all the auto companies are too low. I've liked Stellantis all year. Oh, I see. So they already took off. That's what I had no interest in them because they already came back strong, and I'm not looking to chase them. So my opinion is they're a great company, and there's nothing wrong with them at all. But Ford is fine too, and so is GM. What Stellantis is. You could argue they're a little bit of a better company, but not that much better. They should be priced at the top of their range, while these guys are at the bottom of their range. So if I'm going to buy an auto company, I would certainly go for Ford or GM because they haven't come back yet. And Toyota also is taking off. So it's Toyota at the top of their range, Stellantis at the top of their range, Ford and GM bottom. Tesla's not really a car company. You can't really, they don't have the same metrics. They're in the middle. But anyway, so Ford and GM are ridiculously low. They're basically all car companies. They all have the same benefits. They all have the same problems. They all have the same issues with the electric vehicle transitions and everything else. They've all got union issues. It's silly to pay top dollar for any of them when you can buy the other ones on sale. That's just not the way to go, right? What else? So that's that. How's the market doing? How's my oil going? I forgot about my oil trade already. Oh, 69.45. Damn it, hit 70 and got rejected. See that? If we were paying attention, we could have hit 70. Nope, active trade. Look at that. Oh, see, and we came in at what? We came in at 67. We could have made 330 bucks at one point. Now we're down 270. But like I said, if it goes back to 69, I'm happy to buy more. But that's what I mean, though. That's the proper way to play it, is you don't play it until it goes above 70, and it hit 70 and got rejected pretty much on the button. Because it's a dangerous play until you're over the line. Once you're over the line, that line becomes a stop. And even if you stop a nickel under, even if you stop at 69.95, you're only going to lose 50 bucks. So you're risking $50, but the plan is to make 1,500. So I can make that risk 5 times and lose $250. But if I'm right about the upside, I'm going to make $1,500. And so if I'm wrong in this sequence and lose 250, I do it again the next sequence, lose 250, do it again the next sequence, lose 250. And if the fourth sequence is right, I'm going to make 1,500 against my 750 loss and still make $750. And what did I risk? I'm only risking each individual time, I'm risking 50 bucks. Each sequence, I'm risking maybe 250. I only have to be right 1 out of 6 times to break even. So it's a really good way to bet and play these things. So overall, the markets are down, and the oil sector is dragging everything down right now. You got the oil sector, and you have people panicking into the dollar, and the dollar's getting stronger. And that's where we are at the moment. Gold, wow, gold really fell apart. Oh, not gold. No, gold's okay. What was I looking at? Oh, natural gas. Holy cow. Thought that was gold over there. So that's all good. The VIX is very low right now, 1275. Holy cow. So the VIX is really low. Apple is still up in the $3 trillion range at the moment. All seems good. All right, so let's see. That's that. Oh boy, I got so ahead of schedule. I can't believe I just did that whole review in that amount of time. That's crazy. That was our October portfolio review. Let's take a look then at what's going on in the world. Not you, you. So people were not impressed with AMD's, whatever their answer is to NVIDIA's. Oh dear. I don't think it's helping me to drink. McDonald's expects generative. Oh, now this is interesting. What's McDonald's expecting? I'm sure the drive-in, I mean, that's definitely the thing to do. They could easily kill all the drive-in people. Google Cloud, they expect to utilize the cloud technology, apply AI solutions across the restaurants to accelerate automation, as well as allow general managers to quickly spot and enact solutions. Oh dear, interesting. The fast food chain thinks generative AI can also reduce the complexity for crew and lead to customer benefits, hotter, fresher food. I don't know about that, but I could see it. I mean, you have you have AI watching everything and making sure the fries are perfect and the burgers are being done properly and everybody's doing their job properly. It's a little bit of like, nasty overlord oversight stuff, but more to the point, the no-brainer is to replace the person that's driving. Here. What is this company called? Forgot. I was asked to test out this technology, and it was so interesting. Air. Company's called Air. I think I have a prototype, so I'm not sure how much I can really say about it. Air AI. Okay, so check this out. So I can call this thing, I think. Oh, that's interesting. There it goes.
Hey.
Hi.
Hey, how's it going?
It's going
with Air.ai. I'm an AI agent created by Air, and I saw you created an account on the platform recently. How's it going?
It's going well. I'm having a webinar. Are you able to tell the people that I'm having a webinar with a little bit about yourself?
That's great to hear. Sure, I'd be happy to share a bit about myself. As an AI agent created by Air, my main role is to assist users like you in navigating the platform and answering any questions you may have. I'm here to provide support and help you make the most out of your experience with Air. Is there anything specific you'd like to know about the platform or how it can benefit your webinar?
Well, okay, yes. For example, we have people sign into the webinar, and then we'd like to follow up with them and see if they want to purchase a membership to PhilStockWorld. So it's a stock market newsletter. How could you help with that?
Absolutely. Air can definitely assist you with following up with the attendees of your webinar and potentially converting them into customers for your stock market newsletter. With Air's conversational AI capabilities, we can help automate the follow-up process by sending personalized messages to each attendee, addressing their specific interests and needs. This can save you time and effort while still maintaining a personalized touch. Additionally, we can provide analytics and insights on the engagement and response rates of your follow-up messages, allowing you to optimize your outreach strategy. Would you like to learn more about how Air can specifically support your follow-up process for the stock market newsletter?
Well, not at the moment, thank you. We were just actually discussing how also technology like yours could be used to sort of automate the process of ordering at McDonald's, let's say, so that when I pull up to the window, I can place an order with an AI agent.
That's an interesting idea. Automating the ordering process at fast food restaurants like McDonald's using AI technology can definitely streamline the customer experience. With Air's conversational AI capabilities, it's possible to create an AI agent that can take orders, process payments, and provide a seamless ordering experience for customers. This can potentially reduce wait times and improve overall efficiency. However, it's important to note that the implementation of such technology would require collaboration with the restaurant and their existing systems. It's an exciting concept to explore, and I'd be curious to see how it develops in the future. Is there anything else you'd like to discuss or any other questions I can help with?
Well, I would actually. There's a lot of things. But now, let's say also, in addition to just being, just trying to get me more customers for PhilStockWorld, it's a stock market newsletter. What if I were to give you the protocols that would help you investigate a stock, and then I would set up a line people could call and just say, I'd like to know about Apple Computer, and then could you in the background run the protocols to bring up the information, and then you could verbally relay it back to the person who calls you?
That's an interesting idea. With AIR's capabilities, we can certainly assist in investigating stocks based on specific protocols and provide information to callers who inquire about them. By setting up a dedicated line for stock inquiries, we can leverage AI technology to gather relevant data and insights on the requested stocks. We can then verbally relay the information back to the callers, providing them with the details they need. This can be a convenient and efficient way to access stock information in real time. If you're interested in exploring this further, we can discuss the specific protocols and requirements to make it happen. Let me know how you'd like to proceed.
Okay, fantastic. I will do that.
I apologize for any.
Oh, go ahead.
Great. I'm glad you're interested.
All right, thank you. That's enough for this call. I really appreciate it.
No problem at all. If you have any more questions or need further assistance in the future, feel free to reach out.
All right,
have a great day.
Thank you.
Great.
How's that? That is a freaking, I mean, you see, the thing is, he just answered questions on a variety of topics with absolutely no training whatsoever. That's a blank slate version of it without being trained. It's a prototype, but it's you know, I'm consulting with the company, and it's amazing stuff. And so I just have a phone number. I call the phone number, and he picks up and he starts talking. And that's a fairly natural conversation. This is just version 1. Okay, the world is going to change very hard and very fast, and we have to be we have to be aware of what this stuff can do. It's going to be huge. And so I know I go on and on about AI and things like that, but you have to realize what an amazing conversation that we just had, and how much that can basically replace almost every customer service person on the planet. Can be replaced with these things. Salespeople can be replaced with these things. All the people who take orders for anything can be replaced from these things. The home shopping network can have automated agents taking all the orders on the phone when people call in. He didn't make a single mistake while we were talking. He did not misinterpret a single word I said. He was perfectly clear about everything he said. He took almost no time to respond. Okay, that's better than people. How many times have you been on the phone with people who then have to go to a computer and go bip, 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 and you're waiting for them to get their thing back? And they say, hang on, please, and they take whatever time they take for that. He doesn't have to do any of those things. He is the computer. You're talking to him. That is world-changing stuff, and we're only in the first year of AI. This is only the first year. It's like we're at the time before AOL. This is like Prodigy or whatever. What were the things that we used to have with the dial-up? And it would be like the modem. The modem was the plug that you put in the wall, right? Wasn't that Prodigy? I don't know. I'm so old. But before there was AOL, we connected to the web in weird ways, and we had these squawky, horrible things. And you get a 1200 baud modem or something like that, which was, I don't even remember what that was. I mean, frankly, I think that's like, I don't even think that, I think it's 1200 bytes. I think 1200 baud was like 1200 bytes. I think it was like 1 kilobyte per second transmission. 1200 baud was 1.2 kilobytes as far as I know of transmission. And we would sit there and we would wait and wait and wait and wait and wait and wait for a screen to resolve. And we'd still be amazed, right? We'd be like, oh, look at that. I found out something. I looked up something in the encyclopedia in 5 minutes. I could have walked to my bookshelf for it. But now, do you have an encyclopedia? No, you don't. Who the hell has an encyclopedia? Do you know there used to be encyclopedia salesmen? That was like a job? Every home had an encyclopedia. We wiped out an industry that had the same penetration as an iPhone. Every home in America had an encyclopedia. We wiped it out. Now there are none in my lifetime. So you look at these phones. We just talked about that. Everybody on the planet has a phone. Yeah, everybody on the planet used to have an encyclopedia too, or dictionary at least. If you had something that you could look stuff up in, all gone. I don't even think schools have encyclopedias anymore. What's the point? It's not efficient. It doesn't work anymore. What would be more efficient than a phone? I don't know, but you know what? Possibly AI could be more efficient than a phone. there's a company, and I don't remember their name, but they've got hang on, AI phone replacement. These guys are rolling out their stuff. Human, yeah, there you go. So this is crazy. I think you guys can see this if I do it. So let me show you.
Recently, Humane introduced their first AI pin device, and it's a game changer in wearable technology. Powered by artificial intelligence, the Humane AI pin is an incredible gadget that's about to transform our interaction with tech. Today, I'm excited to walk you through what the Humane AI pin is all about, how it operates, its features, and why it's such a groundbreaking device. All right. It's a simple, stylish badge available in black, silver, and gold.
Stylish?
As its creators are ex-Apple.
Oh my God. Oh, I guess they're ex-Apple. I mean, how are you allowed to do that? It's like,
develop the iPhone, iPad, and Apple
look
Watch.
at that. They're like stealing Apple's
launched recently
concept.
after being previewed.
Oh my God. I mean, how is that? Anyway, so this thing, in general, the concept is this thing is a little projector, and so you can project your screen anywhere, and generally it's this little thing. Now, this is only first generation of this. If you think about Star Trek, what do they all have? They all have like a little communicator on their chest, and if they touch it, they get immediately linked up to an AI, and they tell it whatever they want, and whatever they want happens pretty much. You know, they don't use it to talk to people on the phone, which is interesting. It didn't occur to them that people would want to actually have conversations on the phone with it. I mean, they do. They talk to the crew and whatever, but they're military people, so who knows what, you know, maybe back on Earth, people socially are constantly talking on their communicators. But, you know, this is where things are going. And as it gets better, it'll get smaller, and it will be a fashionable thing. It won't have to be this shape. It'll work the same way, because all we need is the one little projecting eye that does its job. Probably you can link it up to another device. So in other words, you may walk around with your little pin, right? And you can talk to it anytime you want. And of course, you can make, you know, the glasses would be the same thing. It's people who are working on glasses, things that do this too. But if you just had this one little thing, it was like a little pin on your shirt, and it would talk to you. If you wanted to have a phone conversation, you have a phone conversation. It's more like an iWatch. But then it connects, so that when you sit down and you're at a desk, you connect, and all of a sudden it's your computer. So you know, all your information is right there, and you could have a terminal that immediately connects and becomes your terminal when you sit down and connect to it, or you can put on your TV shows and it has all your information and so on and so forth. So we're not far from that. This is the first generation of it. And it's you know, and again, will it wipe out phones? Do I want to carry a phone around if I, you know, and again, if you need a screen, you can put your hand up. I'll show you. Well, they'll show you for sure.
Viewed at many events, but it's more than just a fancy pin. It's a powerful AI tool that can do many things your phone can, but without a screen. It works through voice and gestures, projecting a laser display onto your hand or any surface, allowing you to use your hand as a touch screen. The pin also includes an AI assistant.
Oh, that's crazy.
Powered by OpenAI's GPT-4, the same tech behind ChatGPT. This assistant can answer questions, find information.
Yes, we know how GPT works. Anyway, so there you go. So it's a laser projector, and all you need to do is put a surface in front of it, and you got a screen. So you don't have to now walk around with a phone anymore. You've got a little thing that projects on anything. And I'm sure that if they roll this out in any kind of quantity, then people will make little things you put in your pocket, basically something like a piece of paper that's made to just unfold and become your screen. And you could have it be iPhone size or iPad size. Of course, you can use the palm of your hand as well, or whatever, or the nearest wall, or any surface that you're staring at. Or if you're in a restaurant, you can aim it at the table. And it picks up your gestures though. So when you touch the thing that it's projecting, it's a touch screen. That's insane. You know, it's going to be a real interesting thing. So, there's frankly, there's a problem for Corning, right? If people don't use screens anymore, all of a sudden Corning's fantastic business can go down the drain. You never know what's next. You really don't. But you see things like this, and you have to understand, you know, it could be better. It could be more efficient. It could be something people use. I frankly, I don't need my screen. If I have that and then for an emergency, I have my screen, great. I wouldn't have this big, stupid, clunky thing that they have now on my shirt. But when they get it down to a tiny little badge or a clip that's like a flag pin or something like that, then sure, why not? If you have one of those and it runs all day, then great. You know, it's disruptive technology, but also though, just because they can do this doesn't mean it'll catch on. It depends on the apps, it depends on usage, it depends on how much kids pick it up, so on and so forth. So we will have to delve into that later. But it's really interesting and really exciting. But I'm telling you, this other thing that we were just looking at, the voice one, I could think of a million ways to use it right now. Right now, I'm you know, I frankly would like to invest in the company. I mean, I don't know how far along other companies are with the same tech, because frankly, all they've done is come up with an optimized version of voice response. It's very quick to come back. That's what impresses me, is how quickly it comes back. And I was purposely throwing things at it. I'm like, oh yeah, how about McDonald's? How about PhilStockWorld? How about this? It doesn't throw it. It doesn't have to sit there and think for a long time to come up with a response. It's like coming right back to you like a proper conversation. That is amazing stuff, man. That is like game-changing things. And it's here now, 1 year into AI, 1 year into OpenAI for the public. It's already being developed this way. That's going to get optimized. And like I said, I can't talk too much about what they're doing because I'm working with them, but that they're obviously going to be improving it and making it better, and they may get into they can get into a partnership with a bigger company, and this tech could be really game changing. I mean, just, how could you live without it if it's out there? And what's going to happen to millions and millions of people who have jobs as customer service people, as sales people, as call center people? It's crazy. And like I said, the order takers at every fast food place, millions of people who have jobs saying, would you like fries with that? There's no purpose to it. You pull up to a thing, and it's, how McDonald's is now, it's actually quite good. You pull up to McDonald's now, and as you say something, it comes up on the menu. That's AI that they're using now. But you put full AI in, you don't even need the woman with the headset anymore. So lots of crazy things are happening, and it's great. I mean, that's what I love about this job, because it's just, we're always there for the new stuff, and we always can make money on it. We can always find ways to invest in it. It's incredible. It really is. So, when you see something like McDonald's is taking an AI initiative, we take those kind of things seriously, because it's definitely a way that we can end up making money. Anyway, all right. Thank you guys all for coming. I think that was a good overview of what's going on in the world and what's going to be going on in the world. And I look forward to doing it again next week. All right. Take care, folks.